Tom, earlier we were talking about all the pent-up demand in the market, and it's clear that there's a long list of companies that are in the backlog to complete a public offering. However, we aren't seeing those companies actually close on an offering. In your mind, what will it take to open the spigot and get the IPO market heated up again? And as a follow-up question, what's your view of the IPO market for smaller companies? Do SOX and other compliance costs rule out the public markets as a viable alternative for those small companies? And if so, do markets like London's AIM exchange represent a viable alternative?
Well, I think we have started to see the spigot open to some extent. I mean, if you look at this time last year, we had 4 companies file for IPOs. Latest quarter, fourth quarter of last year, we had 58. And the backlog now is, I think, 66, 67 companies that are actively pursuing an IPO, and about half of those are backed by venture capitalists and private equity firms who need to show exits. And given that there's a lack of credit still, that alternative for exiting their portfolio companies is diminished a good bit still. So we've seen some pickup. We've actually seen some pickup on the offering side. Fourth quarter of '08 and first quarter of '09, we had 1 company in each quarter go public. And last quarter we had 24 and raised over $9 billion in equity capital. So it's opening up, but it's nothing like we had back in '07 when you had in the third or fourth quarter over 90 companies manage to price an IPO. So I think what we need to see for that kind of activity again, if we ever see it again, is for there to be a decrease in the uncertainty, and particularly from Washington. I think people are trying to manage, what's going to happen in healthcare and how's that going to affect my company, what's going to happen in taxes. We're starting to see some of those right now, and I think those are, maybe adding some headwind to it. On the economic side, GDP growth seems to be firming up, but what's going to happen with interest rates? When's the Fed going to, start to shut the spigot off, and when's unemployment going to start to show some improvement there? So I think that's sort of where we get back to a more active calendar of IPOs. There's certainly a supply of companies out there that would like to access those markets. The VCs and the private equity firms, as I mentioned before, have literally hundreds, if not thousands, of companies in their portfolios, some of which are are nice potential IPOs, and they would like to pursue that. I think to your second question, Kurt, about SOX and the small cap IPO market, I'm not sure. I look at the market right now. I think there's a two-tiered market. I think that there are the large companies that are profitable, have critical mass, have a differentiable story that will be able to consider an IPO. But I think that traditionally what we call story IPOs, and not to pick on anybody, but some of the biotech, stories and the alternative energy stories, where it's little or no revenues, let alone profitability, are going to have trouble getting out there. And buyers will pay for quality, and size, profitability, is considered quality these days. There's a ton of capital on the sidelines that would like to participate. There's a lot of these small cap mutual funds that need to find growth for their investors, and they would love to participate in companies going public where they can believe the story. So I think that there's plenty of supply. I think the demand is somewhat subject to how things play out in Washington these days.
First of all, I'll tell you, when I left Prudential 10 years ago, I was thrilled to leave the public capital markets, and I said I'd never look back. And as I sit here 10 years later, I think I'm going to amend that statement, because I believe that firms like Tom's and Randy's have a tremendous opportunity in the coming decade. I think that one of the prerequisites to seeing the equity markets reemerge as a true capital formation vehicle for entrepreneurs is some sort of a rollback in Sarbanes-Oxley. And I don't think that that's impossible. I'm a trustee of a foundation that is spending a lot of money to support several efforts. It's a foundation that was created by Bernie Marcus, who was obviously a quintessential entrepreneur and was a tremendous beneficiary of the public markets in building Home Depot. There are several bipartisan efforts, being led by, groups on the one hand like Newt Gingrich and Joe Lieberman, who have gotten together to form a think tank, and some others similarly, that are really fighting hard to bring some sanity to Sarbanes-Oxley for smaller companies. And they're doing that because they recognize that particularly coming out of a recession, if we're ever going to see the sort of the beneficial side of recessions, and there's always been this sort of thesis around creative destruction. The analogy is the forest fire, which looks like it destroys everything, but really kind of clears the field for new growth. There's got to be capital available to fuel that growth, and the private markets just won't do it. And I think the private markets are going to be less equipped to do it going forward than they have been heretofore, because I think that one of the real impacts of what's happened over the last 18 months or 2 years, and Tom, we probably could go on all day about this, is that institutions are going to look very differently at 7-year lockup kinds of investments than they have historically. I think there's going to be a tremendous premium going forward on liquidity. And so I think that the pool of private capital available to fuel entrepreneurship is inevitably going to shrink over the next 5 or 10 years. And something's got to come to the fore to take its place. The only other comment I'd make is that as I look back 10 years ago, Morgan Keegan and Raymond James were two of the firms at Prudential that we competed against, and you're like the only two left. I mean, you've got the field to yourselves, if I'm right. So I'm actually pretty envious of the position that Randy and Tom find themselves in.
The big guys take a big chunk away from stuff now. Yeah.
I mean, you guys are going to have a field day.
No, these are all big points, and I go back as well. I mean, when I joined the firm in the early 90s, I mean, our practice, I mean, we were really probably, you look at our personal revenue of our business, I mean, we were probably 85, 90%, public equity oriented, and the rest M&A. And that's really flip-flopped at this point because, the market really shut down. And we're a middle market firm. I think it's different for the bulge guys doing multi-billion-dollar deals. I mean, we're squarely in the middle market, kind of dealing with companies in the $100 to $500 million enterprise value range, and there really was no IPO market for these companies. Private equity really took the place as a growth and liquidity vehicle for these types of firms, and I couldn't agree more with Jim's comments. I think it's going to be more difficult for private equity to fill the gap at this point. But SOX is a big issue for these firms. It's one thing for HCA to come back out public. I mean, a very large substantive firm. I mean, when you're a middle market company with a $250 million market cap, these are big issues. And, both from a time, infrastructure, certainly cost perspective, SOX makes it almost prohibitive to come out right now. Also pick up on one of Tom's themes as well from the investor community standpoint of getting deals out there right now. We're, within our capital markets, we're certainly, and with even the smaller cap buyers of these types of stocks, we're certainly seeing, more of a, flight to quality, flight to, sustainability, and guys that were able to withstand the trough, keep their cash flow stable through the recession, that type of stuff, and a little more resilient, is going to fare a lot better than kind of the story of the, hey, we're going to do this, this, and this in the upcoming years, whether it's from a biotech or a, very low revenue, low, no income type company. Those are just a lot more difficult than, a company that's got 40 million of stable EBITDA that has some chances to then enter into new markets, both domestically, internationally, that type of thing.